Hello, everyone, and welcome to our When You're Ready, We're Ready weekly lunchtime webinar. I'm Jim Madel, a financial advisor with Hendricks Wealth and Estate Management. Joined on screen by Tom Anderson, a financial advisor with our firm down in Florida. And then in my office with me, I also have Chris Beisner and Dan Leichner, also financial advisors with our firm. Today, we're going to discuss Social Security and the latest changes to Social Security tax, including new legislation in the One Big Beautiful Bill that, along with a few updates and figures for 2025. There's going to be some time for a brief question and answer period at the end. There is a button down on the bottom of your screen that will allow you to ask your questions if you have any. And if we don't have enough time at the end to get through all the questions, we're going to try to answer them offline following the webinar. So with that said, let's take a look at Social Security tax and the One Big Beautiful Bill. Founded on August 14th of 1935, Social Security has been and remains to be a foundational program aimed at providing financial benefits for retirees and disabled individuals. During our working years, we fund the Social Security program through the Federal Insurance Contributions Act, or as you might otherwise know it, the FICA tax. This is a tax we pay on our earned income. So if you're currently working and you look at your pay stub or your W-2, it's generally listed as FICA tax, as stated above, or in some cases, it's listed out as Social Security and Medicare tax. During our working years, we as employees pay 6.2% of our income into the Social Security program, and our employers contribute another 6.2% of our income into the Social Security program itself. That combined 12.4% of what is what currently funds the program as we know it today. There's another portion of our FICA tax when we're that we and our employers pay, and that's 1.45% of our pay that goes to the Medicare program. But that is not what we're talking about today. The Social Security tax we pay in our working years does have a wage-based limit, or stated in simpler terms, a maximum income that is subject to Social Security tax. For 2025, the wage-based limit is $176,100. That's an increase from $168,600 in 2024. What that means is any income a worker earns above this new wage-based limit is not subject to the 6.2% Social Security tax I talked about earlier. So for those that earn more than the wage-based limit, their paychecks actually increase by 6.2% after they reach that $176,000 in pay for 2025, since Social Security tax is no longer withheld from their paycheck. The wage-based limit changes year to year as part of an annual adjustment to keep pace with the average wage increases, generally changes along with the current inflation rate. A quick side note, the 1.45% of our FICA tax that goes to Medicare does not have a wage-based limit. And therefore, the 1.45% of a worker's salary is paid to the Medicare program by both the employer and the employee. On July 4th of this year, a major piece of legislation, the One Big Beautiful Bill Act, was signed into law. There's numerous tax provisions, deductions, along with much more included in this bill. But today I wanted to talk about one change that has a significant provision for seniors. The One Big Beautiful Bill calls this change the senior deduction, but it became widely known as a Social Security tax cut. Whatever we want to call it, this change provides a new $6,000 tax deduction for individuals age 65 and older. This means that every qualifying individual can reduce their taxable income by $6,000. For married couples filing jointly, that can mean a deduction of up to $12,000. So exactly who is this qualifying individual for this deduction? First, qualifying individuals must be 65 years of age or older by December 31st of the tax year. 2, they must have a modified adjusted gross income below the following phase-out limits. For single filers, the $6,000 deduction starts phasing out at $75,000 and is completely eliminated at $175,000. And for married couples filing jointly, the deduction starts phasing out at $150,000 and is completely eliminated by $250,000. 3, qualifying individuals must have a valid Social Security number. Kind of a no-brainer there. And lastly, the deduction is available only to those filing as single head of household or married filing jointly. It cannot be claimed by those who are married filing separately. So those are some of the limits. Did anyone happen to notice the one big thing that was not mentioned in the list of who is a qualifying individual? You actually do not have to be collecting Social Security to qualify for the $6,000 senior deduction. That's part of what makes it not a tax cut, but instead a tax deduction. This senior deduction is available for tax years 2025 through 2028 and provides a tax benefit for many seniors, particularly in the middle and upper middle income brackets, by reducing their overall taxable income. Your accountant or tax preparation software will know how to account for the phase out if you qualify, or if you even qualify for the $6,000 deduction at all. So while many of the headlines and chatter around the bill stated that it was a tax cut on Social Security income, in actuality, as you can see, it is a tax deduction that reduces the taxable income of the aforementioned qualified individuals. Also, it's important to note that this is separate from any standard or itemized tax deductions you may take when you file your income tax. It can be used to further lower your taxable income by that $6,000. So even when you itemize or if you get a standard deduction, that's $6,000 on top of those deductions that you're going to be able to take for the next few years. The new deduction does not change the amount of FICA tax withheld from your paycheck during your working years. So some people ask, why not just eliminate Social Security tax altogether? Well, for one, if we did that, it would benefit high income high earners the most. If full repeal of the federal taxes on Social Security benefits would primarily benefit higher income retirees, since many lower income retirees generally do not meet the income thresholds for their Social Security benefits to be taxed in the first place. The current taxation levels for Social Security state that if your combined income is below $25,000 and you're single, or below $32,000 and you're married, you pay no tax on your Social Security income. When I say combined income, the IRS definition is your household adjusted gross income from sources other than Social Security, plus non-taxable interest, plus 1/2 of your household Social Security benefits. That's how you get to your combined income. Again, your accountant or tax preparation software will know all this. Combined income between $25,000 and $34,000 for single taxpayers, or between $32,000 and $44,000 if you're married filing jointly, then up to 50% of your Social Security benefits may be taxable. And if your combined income is higher than either of those last thresholds I gave you, then up to 85% of your Social Security benefits may be taxable. So as you can see, as you earn more money or have more income, more of your Social Security is taxed. Therefore, a full repeal of Social Security tax would benefit high income retirees the most. With this current $6,000 tax deduction, it spreads the benefit out across a wider base of retirees. Also, a full repeal could threaten the program solvency. The revenue from federal taxes on Social Security benefits is directed to the Social Security and Medicare Trust Fund. Therefore, cutting these taxes without an alternative source of revenue could accelerate the depletion of the trust funds for the Social Security program. Some analysts suggest that even this temporary deduction included in the One Big Beautiful Bill will accelerate the Social Security Trust Fund's insolvency date to 2032. We're going to touch on that more in a moment. Since its inception, the Social Security system continues to be a crucial part of our economic fabric, and it's likely going to do so for many years to come. The new One Big Beautiful Bill addresses taxes for seniors, but the core revenue stream, which is FICA tax, which is paid by the current workforce, remains in place to fund Social Security for current and future beneficiaries of the program. The long-term financial health of Social Security has been the topic of discussion for many years. However, there are a variety of levers that can be pulled to ensure its longevity and keep it afloat and solvent for many years. Simple changes such as increasing that wage-based limit that I discussed before, if they increase that beyond its current annual inflation-based adjustment, or just increasing the percentage paid through our FICA tax beyond its current 6.2%, could serve to keep the program afloat for future generations. So, despite not being a true Social Security tax cut, this recent change does indeed provide a level of tax relief to seniors through the 2028 tax year, as it lowers the amount of their income subject to federal income tax, a portion of which may include your Social Security benefits. So I hope this webinar helped shed some light on the recent changes in legislation, which should benefit seniors for the next several years. If there are any questions, please feel free to post them in the Q&A section, and we'll answer what we can here. We are looking to make this these brief lunchtime webinars a weekly event. So next Wednesday, following suit, next Wednesday, October 1st, I can't believe it's October already, but October 1st, Sean Hendricks, who is both a financial advisor with our firm as well as an estate planning attorney, will be presenting a lunchtime webinar on general estate planning with a discussion on trusts and wills. And then the following Wednesday, on October 8th, financial advisor Chris Beisner will be discussing traditional versus Roth IRAs. So feel free to look up upcoming events and register for them on our website. Very much the same way you did register for this one. You can find our website at hendrickswealth.com and look for the events tab, and you'll be able to log right into there and get registered for anything coming up. We do have a question here. Is FICA deducted from Social Security checks? It is deducted from Social Security checks in the manner that that is the tax that we pay. So it goes back into funding the Social Security program. So it may be phrased a little bit differently on Social Security checks, but it is the funding of it is actually taken off of there. As I went through before, depending on how much income you have, a different portion of your Social Security will be taxed. But it is an odd thing, but yes, they do tax Social Security. I hope that helped answer your question. And we do really appreciate you guys joining us here. Again, this has been recorded. It will be put out on our website. It will be out on our YouTube channel. So feel free to check it out. If you know someone that was not able to attend and you think they'd benefit from this this information, it was one of the biggest questions we've been asked by our clients. Is everyone thought it was a pure tax cut, and I wanted to shed some light on this. I got a question in here. Is the $6,000 deduction ongoing or temporary? It's only going to be valid unless they extend it. It's only going to be valid through the 2028 tax year. So we got 4 years of it, 2025, 2026, 2027, and 2028. It could be ongoing, but that's all it's really. The One Big Beautiful Bill did have a sunset provision in there that'll expire in 2028. Good questions. And we'll stick around for a few more minutes if anyone has any other questions. Again, the Q&A button is down at the bottom of the screen. give it a few more seconds here, and if we don't have any more questions come in, I will give you all a little bit more of your lunchtime or your day back. And if you have any questions that you think of after the seminar, you can definitely feel free to shoot an email over to us at info@hendrickswealth.com. That's info@hendrickswealth.com. We do have another question that came in. Do we have any webinars on Roth conversions? While we don't have a webinar specifically devoted to Roth conversions yet, we do plan on touching on that on October 8th, I believe. We will have some discussion revolving around Roth conversions. So that will be a part of that October 8th webinar led by Chris Beisner. And if you have specific questions before that webinar, you can always feel free to shoot them in an email over to me you can send it to info@hendrickswealth.com and we can look to answer it for you. Sometimes they're very specific to an individual. So I would also invite you, let's learn a little bit about it, but let's also see if it fits your specific needs. All right. Any other questions? I'll stick on here for about 3 more minutes or so. If you think of any questions, type them in. If not, we will end this. All right. I appreciate everyone joining us. Thank you so much for taking the time out of your day to join us, and we will hopefully see you next Wednesday at the same time. Please sign up again at hendrickswealth.com under the events tab. Thanks so much, everybody.